Hello, everyone. Thanks for tuning in to my podcast, What If? My name is Nancy Fong, and I am a financial advisor with my own firm, NYF Wealth. And today I have Ginny O'Leary, who is my co-host, and we're going to talk about a case study. This is actually a girlfriend of mine who asked me this and the conversation that we had. So welcome, Ginny.
Hi, Nancy. Hi, everybody. We're back again. Thank you for being here. And this case study is an interesting one. So why don't I lead it off with your background of the case study?
Sure. So a girlfriend of mine who's a retired accountant. So just telling you this because this person has very good knowledge about tax and, all of these types of accounts. She asked me for a financial plan because she's retired early. So I used a sophisticated software known as Conquest. This financial planning software is used by 50% of financial advisors in Canada, including those at the big banks and big investment firms. And I really like it because it's so flexible that you can really tailor and make it to everyone. So I had done this plan for her and her husband about a year ago. And now she's asking me, okay, I need to figure out where my retirement cash is coming from. Which account should I take it out of to be most tax effective? And so I went back into my program and then I got the right report for her showing, what to do. And so we had a really interesting conversation about RRSP and RRIF.
So Nancy, thank you for sharing the background. And I am going to dial it back and sound really basic right now. But for those in our audience who are listening, some of them might know what an RRSP is. Some of them might have some vague idea of what it is. Can you just explain to us?
Yes.
What is an RRSP and what does it even stand for?
Yes. So RRSP is Registered Retirement Savings Plan. The Canadian government wants people to save for their own retirement. There are government benefits. So if you work, you contribute towards CPP, which is the Canada Pension Plan. And when you reach 65, if you've lived in Canada for a long time, then you will qualify for old age security. But really, frankly speaking, those amounts are not what we hope to retire on. It's enough for you to get by, but not to have the kind of full lifestyle that we probably want. So the government says, if you save for your own retirement while you're working, we'll give you a tax break now. So for example, if I am in the second highest marginal tax bracket and I decide to buy RSP, I would probably buy enough to kick me into a lower tax bracket if I had the room. Okay, so we're not going to talk about how that's all calculated, but just the basic concept is that if I put away this money now, I get a tax receipt to reduce my income this tax year. Then I wait until I'm 60, 63, 75, whenever you feel like you don't want to work full time and retire. When I take out the money from the RSP that year, that income becomes taxable. Okay, so the plan is we hope that our tax rates after we retire, the marginal tax rate, will be lower. And that's what an RSP is.
Thanks so much for that explanation, because I think it's very clear what the goal of putting money in an RRSP is and what the intention of the government is regarding that. So as we move on, after the RRSP, now we move into RRIF territory.
Yes.
So for any of you in the audience who, same thing, RRIF, I've heard of it. I know it's it's a place where I'm eventually going to have to take money out. I can't even remember what it stands for and what it means. Can you please enlighten us all?
Sure. So RRIF is Registered Retirement Income Fund. What a RRIF is once you decide that your RSP, you've saved enough and you want to start drawing it down in a fixed stream of income, like a paycheck. That's when you switch it to an RRIF. If it's still an RSP, you can take it out this year and not take it out next year. It's flexible. But if you turn it and you say, okay, this RSP, I'm going to tick the box, it's turned into an RRIF, then it becomes, you have to calculate every year, you're going to have to take some out. And the government has minimums that you need to take out. So you can say, oh, well, I'm not going to retire until I'm 100.
Okay, we are living to that age.
So, no, the government knows that you need to be taxed. So the rule is when you reach the year you have your 71st birthday, you have until the end of that calendar year to turn it into a RRIF. One of the things that all the governments try to entice us to vote for them is to say, okay, I'm going to raise that age because, as I just said, Ginny, we're living longer and longer. So in the past, we say, okay, we maybe work from 25 to age 65, and then maybe mortality was shorter in our 80s. We only need to spend the money for 15, 20 years. But now, from age 25 to 65, if I live to 100, that's 35. That's almost the same amount of time I worked, right? And so people are fearing that their money will run out because they live long, right? It's a good problem to have because you have a long life, but also you want to have quality of life. And so the government, starting age 71, you have to make the decision, whether you choose to or not, the financial institution will switch it over to an RRIF if you don't do anything, default. And by the end of the calendar year of the year you turn 71, it will trigger, okay? And so the government wants to make sure they get the tax out of you. So they have a schedule. Each age, so 72, you must take out 5-point-something%, like every year. And then it gets higher and higher by the time you're maybe 90. It might be like 20%. So that the goal is to drain it. And then every year the government will be collecting tax on that income that you declared. Because you never paid tax on it when you saved it, when you contributed, right?
Yeah, so Nancy, thank you so much for explaining that. I personally, everybody, feel like this was the clearest explanation of a RRIF.
Oh, can't be, Ginny.
Seriously, yeah. So that tells you about my financial planning knowledge, but this is, and I knew about that at some point at the age of 71. If you don't do that, the financial institution will do it for you.
Yes.
But when we think about that practice, is there an ideal time to convert it from an RRSP to a RRIF? So let's say I'm working with you.
Yes.
Would you ever recommend doing it prior to the age of 71?
Yes. So financial planning is so individual, right? It's kind of like what I always tell people about estate planning. You can't ask what your neighbor is doing because your neighbor's situation is very different. So there's a number of questions that I would ask my clients. Do you have a spouse? Is your income stopping from other sources, work or investment income? And one of the things that maybe not everyone is aware of is if you start taking RRIF, you get an extra pension credit on your tax return. And so that might be a reason to take it or not to take it. The girlfriend that I talked to, because when we did her schedule of where to take her money out, actually my recommendation was to, from her age of 55 to 65, before she maybe wants to call on her CPP, is to maximize each year, take out of RSP. And so she has other sources of income. So you figure out, okay, those are the things that pay for my, living expenses, my phone, my car, my insurance. That's what we call a paycheck, to cover off whether you are enjoying yourself or not, you still have to pay. Then we have a play check. So when you are looking at your RSP, if you have enough income source to pay for your paycheck, then don't take out of RSP unless you need it. So at the end of the year, I went to that big trip with my family. Okay, I need to pay this credit card bill. Okay, there's no more in the paycheck. Then I will take it out. And this is very rare advice that you hear from financial advisors. They always say, save it, take it out as little as possible. But I figured out that if you, for example, have an RSP and your financial advisor is doing great for you and making 8%, the minimum when you do the RRIF is 5%. So that means you're never eating into the principal, because the gain that you're getting is always covering what you need to take out. So did you know when a person passes away, immediately all that RSP is taxable income for that last year? And that means instead of being in a marginal tax rate of maybe 43%, in BC, the highest tax rate is 53%. So if you still had $200,000 in your RRSP, I think it's more than that now, $250,000, you will be in that marginal tax rate of 53%. If you take it out bit by bit before, right, then you won't have that problem. And then you rely on your CPP, your old age security, during the time when you can trigger that. And also, so people say, well, I have a spouse, so I'm going to get a rollover. So if I die, I make my spouse the beneficiary of my RRIF or my RRSP, then they don't pay tax until they die, right? But same thing, that person, if they don't spend it all, when they leave it to the heirs, kids or nieces or nephews or your favorite charity, it gets taxed before it reaches them. So, Ginny, do you want to know the best tax strategy ever?
Yes, please. I really need to know that, because I was just sharing with Nancy earlier that I just had to pay tax, future tax.
Tax installments.
Tax
right?
installments.
Yeah.
So I would love to hear the best tax strategy ever.
So the best strategy is to get married, so you have a spouse, and when your spouse dies, then that spouse, you have to get married again to a younger spouse. And every rollover is to the younger spouse. So when that spouse dies, that spouse has to, when you die, that spouse has to marry somebody younger. So that is the only excellent tax strategy that I've actually come up with, is just to do spousal rollover over and over and over again. But as we know, that's not a real strategy.
Everybody, if you're like half listening, that is absolutely not a real strategy. Okay, just as if you're like me and you're thinking this is really interesting with these ladies, did I hear that right? This is the voice of reason. That's not real.
Yeah. And so when you take out your RRSP, the Canadian government says we're worried you're not going to pay your taxes. So the financial institution already holds back a portion for your tax. So if you withdraw $5,000, you will only pocket $4,500, because the financial institution will have already sent 10% to CRA. Between $5,000 and $15,000, the holdback is 20%. And between $15,000 and up, it's 30%. So interesting you said, Ginny, about you had to prepay tax installments because one year you had a super high income. Well, if you are taking out of RSP and not relying on RRIF, you're actually going to take some out to declare for the next year, you can actually ask the financial institution to hold back more than 30%. And there is your prepayment of tax.
Wow. See, you know what? I should have talked to you before I paid that.
You have your own financial advisor, but
I do have my own financial advisor.
Everyone has different advice.
Yeah, everyone has different advice. And I was going to say, but I think this was very enlightening because I think that is top of mind. And again, I am going to speak to any of the women, and I know this audience can be obviously everyone, but any of the women listening, I think this is really important because we are always, I think, more than the men, that's just a little bit of my experience, thinking, is it going to run out? Is it going to run out? Because we are natural caregiving individuals. And I feel that this was a very good case study. Very good information. Kind of, I would say this is the most technical so far we've gotten at this stage. And I find that's very helpful. So we're hoping all of you have learned something today about RRSPs and RRIFs and what they mean.
Thank you for tuning in. See you next time.